Welcome back to Primary Source China Investments. This week we're on show B7, and we thought we'd try to explain why Chinese stocks are simultaneously becoming less attractive and harder to purchase. There are two major reasons. The first is the supply side. Just this week, MSCI cut 59 stocks from their EM index. 54 of these trade on the mainland and 4 in Hong Kong. This is in addition to the May review, which saw 56 stocks removed and another 66 in February. We don't know what the exact weightings will be come September 1 of the MSCI EM, but given the July 31st China exposure was down from 40% in 2020 to currently 24%. Conversely, India went from 8% in 2020 to 20% at the end of July. Just so we don't get comments, MSCI includes Hong Kong with China, but counts Taiwan separately, you can see on the chart. It's largely the result of India's stock performance that's causing the rebalancing, as the Sensex index is up more than 12% year to date and 44% in the past 3 years. Second, supply side. China significantly curtailed northbound market data. In other words, they're closing a window on market sentiment. More on the supply side. There are 4 bills that were introduced in the last congressional session in the US, all focused on China-listed stocks in the US. The most severe would effectively ban all Chinese stocks from all US ETFs. And these are probably aspirational for the Congress people introducing them, but all of these will get votes. And don't forget, with the stroke of a pen, Biden banned 59 Chinese companies in June of 2021, causing US listed ETFs tracking the CSI 300 to eliminate a few companies. One more point on the supply side. 2 years ago, SEC Chair Gary Gensler and the Public Commission Accounting Oversight Board required new audit requirements for Chinese companies listed in the US. Some of those companies chose to delist. Others are in various stages of compliance. Remember, there are more than 250 Chinese companies listed in the US. Only about a dozen of them are considered large cap. That means they would fit into the S&P 500 with a market cap above 7 billion. The reason I mention this is because the cost of compliance is high for a small company. The PCAOB also fined PwC in Hong Kong and China. And if you haven't been keeping track, PwC is about to get a 6-month ban over the Evergrande audit. This doesn't require a high-level problem-solving mentality to see where this is going. Pengguo, any thoughts or comments on the supply side?
So many reasons, I think the market has already discussed it. It's really like the big cleanup period. So investors, even all the government, and also the public companies itself, including the MSCI, so really review in the recession period, or especially in such time. So they have to get more criteria to screen the companies. Obviously, qualified companies get reduced, plus more compliance related thing. This happened in the U.S. market and also in the China market.
Yeah, I totally agree that all of these index providers, they are rebalancing. And a lot of that has to do with the other side of the equation, which is the demand side. You know, past performance commentary aside, Chinese stocks have been a horrible investment and a huge opportunity cost for foreign investors. Here's a chart of the ASHR, which is the CSI 300, MCHI, generally the largest Hong Kong listed, and KWEB, which is China Tech. This is a 5-year chart, pick your poison. A good proxy for the secondary market is the primary market. And when I say the primary market, I mean foreign direct investment, private equity, those kind of things. It's at a 30-year low. So not only are foreigners not buying stocks, listed stocks, they're also slower in getting into the primary market, private equity, or building their own plants in China. So we've covered this a lot. And investors, strategists, even consultants who want to get of the proverbial curve, I would suggest looking into getting a Hong Kong account and invest via Stock Connect. I think we've said this many times, right, Pengguo? If you want to invest in China, you really have to get closer, not further away. And getting further away just by picking and clicking on US ETFs, it's going to get harder and harder. Both administrations in Beijing and in Washington have signaled this. And it doesn't matter who the president of the United States is. It's definitely a bipartisan issue that for a number of reasons, China bad. So that's going to affect what happens to investors. And if investors still like the idea of the China growth story, or they like specific companies, strongly suggest get an account in Hong Kong and invest through Stock Connect. What's your thought, Pengguo?
And right now, this is really the period that we should increase our interest to the China market. Number one is the real estate market is relatively stable. So if you see the China real estate index is already started to bounce back. So people have to pay attention to this area, and also for the consumer consumptions. So the downgrade is still the same, but the growth is pretty strong. And also the PMI index and already show is reached to the bottom. So all those things make the stock market, you can see, is still get small volatilities in the bottom period. So that is definitely a good sign to show not too many space to go down, but it could be, but it's hard to go up. So anything want to go up, there have to be many more factors to put them together to push the stock market up. And consider the pretty bad global environment and a lot of the region conflicts, and as well as the U.S. economies have the big inflation or recession risk. So that's also added a lot of uncertainty to the global economy. And the China government also have the policies also have the huge impact. So watch to the China government. So where's the income coming from and how they spend the money to the society. So those kind of things also is pretty clear and pretty predictable. So overall, is still in the high tech area and auto, high-end manufacturing, like the railway, space, and airplane related area, and also computer telecom related area. That shows the bigger growth. So we have to do the fundamental research to figure out the leading companies in those areas.
Well, we're going to leave it there for show B7. Thanks for tuning in, and we'll see you next week.
Thank you.